Good morning, everybody, and thank you for joining us on our webinar today. And I want to welcome you to the webinar, which is the latest in a series of webinars that we have brought to you, co-hosted by ourselves and NJM Insurance Group. We've tried to bring to you topics that are very interesting to the small business market or the business market of New Jersey. And today's topic, which is securing a business loan, probably is of particular interest to many of you because what we're trying to do in New Jersey is grow our economy, and to grow our economy, there needs to be access to capital for companies, and the most traditional capital for companies is usually a bank loan. So that's why today's topic should be of particular interest. I want to thank the NJM Insurance Group for joining with us for the third year, bringing these webinars to the business community. They've been a great partner of ours. They're a great corporate partner and a great corporate philanthropist in the state of New Jersey. Good people to have, good people to work with, and I want to thank them for all their support over the years. So this is going to be a pretty free-flowing webinar. I'm going to ask the five distinguished bankers that we have to give a brief overview of who they are and where they're from and what they do. And then we'll get into some questions and just have a dialogue that hopefully will give all of you some information on how you might approach banks for the need to borrow. So with us today, we have George Destafney from OceanFirst. We have Andy Fernandez from Bank of America. We have Vito Giannola from Provident. We have George Markman from Wells Fargo and Fabio Oliveira from Chase. So George Destafney, you want to kick it off?
Hey, thanks, Tom. Good morning. Good to be here. Thanks for having me. As you said, I'm George Destafney. I'm the Chief Community Banking Officer for OceanFirst Bank, which is based in Red Bank and Toms River. So we're about a $13 billion community bank, 40 branches centered throughout New Jersey, but we've got a presence from Baltimore to Boston. We've been around 120 some odd years, and we're heavily involved in the business banking spaces. So it's a great opportunity for us to have a chat. So thanks, Tom, for having me. Good morning.
Hey, Andy.
Hey, good morning, everyone. Andy Fernandez, representing Bank of America, and I support space anywhere from $1 to $15 million in revenue. Local businesses in the state of New Jersey. Tom, that's it. I'll keep it nice and short.
Okay, Vito.
Good morning, everyone, and thanks for having us as well. Vito Giannola, Executive Vice President and Chief Banking Officer at Provident Bank. My responsibilities is overseeing small business banking and business development. Also, different types of go-to-market strategies that involve community involvement, investments, and everything that touches that retail customer. So under the umbrella also includes the 140 branch network that we have. And I'm happy to be here today. So thank you.
George?
Yeah, thanks, Tom. Good morning, everybody. My name is George Markman. I lead a team in central and southern New Jersey for the middle market for Wells Fargo. Been with Wells for the last 9 years, and prior to that, I spent about 10 years with Bank of America. So thanks, Tom.
Fabio.
Good morning, everyone. Fabio Oliveira. Thank you for the opportunity to be here today. Been with Chase for 5 years now, senior relationship manager here, operating within the space of $5 million to $25 million in revenues. Focus up and down Jersey, mainly Middlesex and Mercer counties. I've been with Chase for 5 years in the financial industry over 20, and looking forward to today's discussion around how to apply for and get a business loan. Thank you all the participants for carving some time out of your day to be with us. Appreciate it.
So let me start out with a very basic question. When I was in the banking business and lent money many years ago, I was always driven by what they then called the 5 C's of credit, which were character, capacity, collateral, capital, and conditions. Do those 5 criteria still matter today in lending because of the over-regulation that has been placed on banks?
I would say so. This is Vito. Those 5 C's are truly a big part of what we do today when we're looking at credit, but more specifically in the small business arena, It's really a lot based on personal credit scores since we're lending to the individual. But more importantly, our relationship manager's responsibility as we're bringing in loan applications and meeting with clients in our markets is really to spread the word and really put a good understanding of what the character is about, understanding the business. So truly, the credit is a big part of it, but everything else that surrounds that is a decision that we look into as well.
Okay.
And Tom, I'd echo that from George at Wells. It was funny preparing for this call. I went into some of our training material for our new hires, and the 5 C's of credit still exist. So we start our calls, as you probably remember, it's weekly or monthly with talk to me first about character. And then, like Vito said, kind of round out the rest of the story, drill in on the credit, drill in on the collateral, the conditions, and the cash flow and that sort of stuff. So I think that still rings true.
And I just want to echo that. We have actually walked away from deals because of character issues. So it is still important that that's being looked at. I mean, that's not the only factor, but it is a factor in determining whether we're going to extend credit or not.
Okay. George or Fabio?
Yeah, listen, I think we're all here, Tom, because we're all passionate about the small business world, right? So when you say, do the 5 C's of credit still come into effect? And I'd say, yeah, but there's probably a couple more that got thrown on top of that, right? So I think we're engaged and we like entering the space. This is a market where we think we can make an impact. The regulatory environment makes it interesting for us, where we have to kind of add some things as the years have gone on. But I think at the end of the day, if you were to ask any one of us, the idea would be find out how a way we can get those 5 C's of credit and a couple others that got thrown on top to make sure that we're providing capital and access to capital to people in our communities that need it.
I will say that character is huge. It's not just about credit and cash flow and the other C's, but character and the RM one-on-one capability to tell the story on behalf of the client to an underwriter in some state or some town that doesn't know that business or the geography or the area that they're targeting. It helps tremendously. Having an RM that knows the business, that understands the business, as well as a business tell their story, their passion, their vision, all plays an intricate part in getting to a possible approval.
So with character still being an important factor, I would assume that the networking opportunities in New Jersey for all of you and your lenders to get out and meet people and understand who they are and find out their reputations is something that you are really encouraging to all your lenders. Is that correct?
Yes, being active, being visible in the market, giving back to the community, being in the community, visiting your potential clients, your potential competitors, just being known in the community. That plays a big part, especially when we're able to leverage how you've given back and played a character in your community. Is all tremendous when preparing an op memo, if you will, to an underwriter about your history and what you've done in the community and what you plan to do with, for example, this loan.
Yeah, I would like to add to what Fabio's saying because we have the same model here, but I would even add to that not only having the relationship managers in the field, understanding the businesses in the communities we serve, we have a dedicated small business underwriting group just for small business lending, which I think is very important. So as we're constantly bringing in credits within our market, the underwriting group and the relationship managers have a better understanding of the markets and what the needs are. And then obviously the relationship manager add that character piece that the underwriters don't see. So I think the partnership between both groups is critical for us to, like George said before, give them, our small businesses in the markets, access to capital, which is what we're here to do.
Like anything else in banking, Tom, the world has changed, right? You kind of need to be everywhere for everybody, right? You have to have a delivery channel available for people when they need it. So you got to go to where your customers are telling you that they're going. So, RMs out in the market is critical and important. And I think we're all want to be out in the market as much as we can. I think that's very important. But we also have to be available in other ways, other channels, right? Our digital experience. What does that look like? We recognize business owners are busy, right? So if it's 10 o'clock at night and they need information around, or that's when they're available to start an application, you need to have that technology available. So like all of our other types of banking, we're going to meet where the demands of our customers are going. And we're still coupling that to traditional being out in the market and have boots on the ground. I don't think we ever get away from that.
So question I would ask of all 5 of you is, as companies come to you for loans, what information would you ask them to bring to you so that you can begin to properly evaluate their request?
Tom, I can jump in. I think one way we usually start our meetings across the state and the country is to sit down with the business owner and anybody in finance and really get an understanding from their perspective as to how they see their business, how it operates day to day. Truly get your arms around exactly what it is they're doing before you get to the asks around the financial statements. So, oftentimes we'll want to take a look at how the company's done over the prior few years. As Vito kind of touched on, an idea of what ownership looks like is always helpful, and also where they're going. What are they driving towards? Because I think that's how you can best be a consultant and a partner to help get them to where they see their ultimate vision go.
George, regarding financial statements, do you require audited statements or will you accept compilations?
Yep, great question, Tom. It all depends on the ask. So usually for us at Wells, if the ask in the sense of the loan size is north of 10 million, then we'll start getting into that realm of audited financial statements. Under 10 million, a compilation, a review is great. And often under 10 million, you may just have some internally prepared numbers depending on exactly where the ask lies.
How do the rest of you deal with compilations versus audits?
Yeah, we follow the same flow that George does. There's that criteria. So really in the small business arena, at Provident Bank is loans up to $1 million. And as you get more into middle markets and higher volume type businesses, audited would be required. But just to spin off what George said before, understanding the owner, the character, right, when they're applying for the loan is important. If it's just steady business and they're looking for working capital, I think the conversation's more towards cash flow and what the needs are. Maybe treasury management services need to be involved in the conversation. But when it comes to just maybe expanding the business, I think it's real important that they come with a business plan that's basically explaining where did I start, where am I today, and where am I looking to go, which is the same thing, kind of what George is saying. That's very important for us to put together the story as we look at the credit. But in regards to the financials, we follow the same type of model.
And I'll echo that on Chase side. We usually start asking for compiled or reviewed financials. Once we start crossing that 2 million, 2.5 million exposure, when we reach about that 4 or 5 million, we start looking at maybe potential audited financials. But it's also dependent on the type of credit. If you're looking for a commercial mortgage and it's a $2.5 million ask, brick and mortar, we might not need it or might be able to get away with it because the collateral is there. It's a solid foundation. Whereas a line has a little bit more risk associated with it, for example. But to the point earlier is it's not just about financials. It's when we meet with the clients, it's the high level overview of the what, the why, and the how of what you do and how good you can explain it to us because we're your advocates here at the bank to our internal folks, with the powers of approving the client, for example. How good you can tell us the picture, how good we can absorb it, how good we understand your industry, and then put pen to paper to get that picture painted for our clients or our prospects to get the loans approved.
Okay. So is there an appetite at all for loans that are limited from a collateral standpoint, or does collateral still play a very important role in your lending decision?
Tom, I can take that. So it all depends on the loan. Here at Bank of America, we consider ourselves a cash flow lender. So we really look at the cash flow and how the business is trending. That's not the only decision, but typically, if a client does not have collateral, but the cash flow, that weighs heavily on our internal partners on whether they're going to proceed with the loan or not.
Okay. Anybody else?
Similar to bank, also cash flow lender. Collateral does play a big part. We want to make sure that we are collateralized on our loan amount. If there is a potential shortfall in collateral, we try to lean into maybe the SBA or one of the local community CDCs, RBACs to help us with the request. But we do like to see the collateral there in terms of supporting the projects.
Mm-hmm.
Yeah, I would add to that as well that, cash flow lenders here, C&I business is a big part of our business. And as we're looking at different credits, because it definitely varies, a UCC filing would be something we would put on as a collateral where you kind of look at unsecured. So we would need first lien on that. So I wouldn't say that there's any product today that's completely unsecured with no UCC filing, no collateral at all in the space that we're doing business with today.
So it sounds like cash flow is a primary driver, obviously, to make sure that the cash flow is there to pay the loan that's being requested. But the strength of the cash flow would dictate the collateral that you would try to go after, and it would be kind of in direct proportion to the strength of cash flow versus the need for collateral. Does that sound right?
Yeah, that's right, Tom.
Okay. So in that context, from the standpoint of cash flow, startups have no cash flow. They have projections. So how do you deal with the very strong reliance on cash flow to evaluate a company that is starting?
Yeah, Tom, it's George Markman from Wells. I would just start by telling you that with, at least within Wells Fargo, we've got different verticals, and startups specific to tech. That's a vertical inside of Wells Fargo that we're very focused on, and we want to be there to help those companies get going, and then obviously grow through their life cycle with the bank. I think the lens just changes, Tom, in a drastic way. You're going to really be reliant, one, on the story, as we said, but two, on ownership that stand behind this startup company. And we do a lot of that, mainly out of New York, covering companies in New Jersey. But we actually absolutely have the resources to support companies like that.
So that's where the character factor kicks in about the experience of the individuals in the business that they're trying to start up, and that becomes a more prominent factor in a startup.
Yep, but we do a lot of it.
And to add to that, your business plan, how effective is it? Tell your story, tell your vision, tell the future, why you want to get into this industry. The business plan there plays an intricate part in the underwriting process, and we would also look at obviously outside cash flow, so your personal cash flow coming in from your W-2 paycheck, if you will. But business plans on a startup, projections, year one, month over month, year two, maybe a month over month or a full year P&L and balance sheet projections plays a big part. An executive bio, executive summary, a resume plays a big part if you're coming in as a startup for startup loan.
Yeah, I would add to that as well. Again, dependent on the industry, the business that you're in, the experience you have as the owner. We have different verticals as well that we focus on. So SBA may be an option. We have a healthcare group that focuses on that industry. So as we meet with the individual and see what their needs actually are, including all the things we just heard from Fabio and George in regards to projections and the storyline and the experience, and all will depend where or what alternative business line we could incorporate into the conversation.
Okay.
Tom, what I would add, it also depends on the industry. So just going back to what we talked about healthcare, like I'll give you an example here at Bank of America. We do startups all the time for healthcare folks coming out of dental school, up to like store number out there up to $500,000-$600,000. For other folks that are maybe not going into a specific field like that, we do have solutions for them to help them grow their business. So it all depends on the field or the business that the client is looking to go in.
There's options out there, Tom. Vito talked about the SBA. That's a good option for startup type businesses. New Jersey has the New Jersey Economic Development Authority, do a lot of good work around there. And then there's CDFIs that are helpful for some of these smaller microloans. The Union County Economic Development Committee, UCEDC. So if folks are out there looking for real guidance about how you can dig into some of that business plan that Fabio talked about, those CDFIs could be helps there. Actually, listen, if you just Google New Jersey CDFIs, there's probably about 30 of them that are available in our community. Renaissance, a couple of those folks. So, for the newer businesses that are typically a little bit harder to finance, there's some great tools out there, especially in New Jersey, to look through how you can make that happen.
Yeah, I think, companies who are approaching you for loans, many of them are probably not aware of the assistance they can get from the SBA, the EDA, CDFI. So do you all have relationships with those other organizations so that you can help bring them in to help you shore up a potential credit?
We do, and that's what we should be doing, right? When folks coming in and we talk, I think each of us talked a little bit about the importance of relationship and getting to know folks and getting to know the situations. That's where I think the rubber hits the road, right? Where you're really listening, trying to work through solutions, and then getting people connected with the right organizations to make sure that they have a fair shot at it, right? That's where I think we all like to play.
Yeah, when you think of that, the overall, if we're not able to provide the credit to a startup per se, and we could get the right organization involved to support it, and we could be there along the line with them, getting their accounts, potentially their insurance and things like that. At least we tie them in early on, and then ultimately take them to a conventional setting product. So I think it's a win-win for everybody for us to stay engaged and support the small businesses, even if we're not doing the credit upfront.
Okay. So I'd like each of you to walk me through the approval process that you have at the bank from when a potential borrower comes and sits down with one of your relationship managers. What is the process internally that you go through to approve the loan, and how long does it take?
I'll start that off. So we have 34 market sales managers within our footprint that are focused on small business development. They're credit trained, so they have the knowledge of really having an intelligent conversation with that small business owner to come in as we're looking at financials and getting ready to apply for the loan. So our people are really coaching and mentoring the small businesses to kind of go through, make sure everything is set the right way before we actually put the application in. Because keeping in mind, when it gets to this dedicated small business underwriting group, they're looking at the cash flows, they're looking at the story we're putting together, and it's kind of hard to go back and forth when you could put everything in up front. It just makes it a lot more seamless. So our relationship managers have a digital platform that they put the application through. And I would say within 24 to 48 hours at max, we're already getting a response if it's approved or not, or we need additional information. And we have everything run directly through the relationship manager today, so they could be the point of contact to run that application and make sure it gets done, simple, fast, and easy. That's the need, right? Access to capital, the simple, fast, and easy process. And I think that, it's a differentiator for us here at the bank, just having that group that's dedicated to those loans up to $1 million. That really, I think, puts us in a good position as we're communicating with clients and going through the application process. So we get the response from underwriting, and then we get right back to the customer on next steps if there's more information needed.
Okay.
I will say that, if I can go next, I will say that having a complete package helps tremendously versus piecemealing. So, ideally, you'll meet with the RM or the banker, step one, kind of get an idea of what you're looking to do or accomplish. Once we put together a complete loan package, if we're submitting it today, we typically get a response within 5 to 7 days turnaround on the Chase side. Depending on the complexity of the deal, might be a little longer. If it's an easier deal or smoother transaction, smoother deal might be a little faster. But typically, our turnaround time is 5 to 7 days. And then once we get the approval from the underwriter, go back to our client and discuss rate, term, etc., and next steps. What needs to be done in order to get this to the closing table. But from day one, full package to actual decisioning is usually about a 5 to 7 day turnaround.
So, Tom, and I just want to add a different angle here. What delays a loan decision sometimes is the underwriter may have questions, and there's just a delay when working with the CPAs and getting information. So the faster that the client or the CPA, whoever is handling their financials, responds back to the questions or anything else that we need, the faster we'll know the answer. But 7 to 10 days is typically what the response time around. But a lot of it also has to do how fast the customer and the CPA are responding to some of the questions that we have.
Yeah, Tom, I'd probably echo a lot of what Fabio said. Fabio, our system is very, very similar. We'll actually do what we call a 2-minute memo, Tom. So it's a 1 or 2 pager overview with all the bullet points on the ask, on an overview, obviously, of the business and anything else that might be helpful. And then we come together rather quickly with our risk officer here at the bank at Wells, and we'll make a decision. And then, as Fabio and Andy stated, kind of follow the course from there on legal documentation and getting that loan in place. But I think 5 to 7 business days is pretty reasonable, and closing a new loan facility inside of a month is about right.
Yeah, it's about right. Yeah.
The I'm going to start with a typical banker answer, Tom. It depends, right? I think that's how we could probably answer most of the questions this morning. In our business banking segment, which we define, it's very similar to Vito. You get a conditional approval or conditional answer the minute you hit the submit button. You get it, and then the closing from there is really driven by what we're looking to. We talked a little bit before about collateral. From taking a piece of real estate, obviously that adds a little bit of time. If it's a UCC filing, as we talked a little bit about, that's certainly quicker. But I think that's about right. We get a conditional approval very quickly, and then we can work on the diligence documents from there. Typical app to close. Again, it depends, but you can do it in 30 days with real estate, 45 days, something like that.
Is there, in any of your banks, is there a dollar limit size above which it has to go to a formal credit committee for approval, or is everything done with a concurrent system of officers?
Tom, at Wells, our threshold is 3 million. So if the loan size is over 3 million, it does have to go to credit committee. Obviously, as it grows from there, they can get more and more complicated with how high inside of the credit committee you need to be. But 3 million is our threshold where that begins. Under 3 million, it's more a decision made by the line.
How often does the credit committee meet, George?
We actually meet weekly. So we sit down on a weekly basis to address any opportunities we have.
How about the rest of you?
Yeah, I would just say on our side, in the small business world, we do up to $1 million, where it's just the underwriter and the relationship manager going back and forth. What's in policy gets approved and follows its course. Obviously, with some oversight. As you get up to 3 million, 5 million, 7 million, it goes into commercial lending, and in the commercial lending segment, there's different sign-off requirements. So that goes up to about 7.5 to 10 million with local sign-off. But then above that mark goes into credit committee, and we meet weekly as well. And again, it's based on overall exposure, right? Which I'm sure is similar to everybody else. So if you come in from a $2 million request, but your exposure with the bank is 10 million, it's going to go to credit committee because they look at overall exposure. But again, we meet weekly, and it's pretty quickly on getting the response back to the client.
On the Chase side, there is a credit scoring model under 250, depending on credit worthiness, industry, time in business, et cetera, might meet certain criteria for a quick approval. Traditionally, our loans over 500,000 go through formal underwriting. The higher the exposure, it goes through just different set of eyes. If you cross that 2 million, 2.5 million, might require a second set of eyes from an approval capacity. But there isn't the formal credit committee where we bring the deals and it's reviewed amongst the senior leaders for an approval or declination. But it really depends on exposure. It depends on the credit deal. Depends on what type of credit. If it's again a mortgage, it might be weighed differently than $2.5 million line or $2.5 million mortgage. They're weighed differently because of the risk associated with it. But yeah, it's really dependent on exposure. But in terms of credit committee, at least to the best of my knowledge, in the business bank space, we don't have a credit committee. It's through our underwriters and then his or her manager.
Here at BOA, similar to Wells, usually over $3 million, we meet before the deal is submitted. And I think that's a positive thing because then we can look at some mitigants or how we're going to tell the story to the underwriting team. So that's typical for the deals that we submit here.
Okay. So are there industries in New Jersey that you all prefer not to engage in, or is it basically based on the strength of the company in any industry and the people involved with those companies? Again, the industry situation sometimes prevents your appetite for loans, but are there industries that you shy away from?
Well, New Jersey's tricky, right? With the legalization of cannabis, that's one that it's legal in the state of New Jersey, but still a class 2 narcotic and federally regulated, right? So that's a hard one for us to jump in yet. I think most banks are trying to formulate a policy around it. Some have already done it. So there's never to say never there, but that'll be something that evolves as an industry that's bankable, financeable, probably in the immediate future, in the next 6 to 12 months as we figure this out.
Aren't national banks prohibited from dealing with cannabis?
They are, but some still do, Tom. Right? So there's a calculated risk there. Some of the state charter banks take that risk there, but the banks are absolutely prohibited from it. And there's some legislation out there that's working on the SAFE Act is out there that's trying to address it on the national level, but it still makes it a very complex on a local level here in New Jersey.
Anybody else have comment on industry?
I'd echo George's comments on cannabis, and I'd probably build on it and saying that one of the tough asks that has come up for me from time to time has been lending to businesses that then go out and lend that money yet again. So those will be a challenge. And Tom, as we discussed before everybody jumped on, in the real estate segment, office has been tough. Wells Fargo has got a rather sizable position in the office market, especially in New Jersey. And at this time, we're sort of pencils down on any new office loans from a mortgage perspective. So that's one more.
So not too long ago, there was a liquidity scare in banks, deposit runoffs, the Signature Bank, all that stuff that happened. And there was a comment because of the deposit runoff that banks were reducing their appetite to lend. Is all that behind us? And are all of you actively soliciting new borrowers today?
Yeah, I'll start that off. Absolutely. Our conversations right now in all our executive meetings is how do we keep moving the business forward? Always a focus on core deposit growth. I think that's everybody's focus on this phone today, because as we bring in the relationships and the core deposits, it allows us to have more liquidity to lend money out, right? So we're absolutely in the business to do business and looking to bring in more customers to the bank.
And I would agree with that. We are aggressively, we are lending, we are doing loans day in, day out. We're not expecting to onboard a client, especially in that 5 to 25 space, that does not have a loan or a line that they're going to want or need to bring over with the relationship. It's cash flow, it's credit, it's your collateral. It's, how good you can paint the story. It's the relationship you built with that client or that prospect to win the relationship over. We are lending. We just got to sit down and have a talk and see how we can get you from point A to point B. Even if it's not today, we can paint a roadmap, 6 months, a year to get you into that vehicle. But we are lending.
Yeah. Same here, B of A. It really hasn't stopped us from going out to the community and talking to folks about access to capital. So we're still on the same course that we've been on for the last couple of years in small business banking combined.
Yeah, same here, Tom. We're at lending and want to be out there in the markets and make sure that we're providing the capital that's necessary. Listen, there was a period of time last March where things got a little bit hinky in the banking space. I think that's kind of we created some distance there in the rearview mirror. And not that you're back to business as usual. I think George brings up a good point. Office, real estate, investment real estate, some of those asset classes get a little bit harder, but that's really driven by the credit more than the liquidity, right? Some of the risks in that space.
Yeah, same, Tom. We're very aggressively looking to bring on new relationships.
So what are, based on your extensive histories in lending, what are some of the more common mistakes that you see potential borrowers making when applying for a bank loan?
Well, I would give probably a similar answer a lot of people are thinking about that may not say. Is usually when you come to the bank when you need it most, and that's probably when your financials are probably in the worst position. So I think sometimes, like we were saying early on in this conversation, is preparing yourself for the future, having the conversation with your banker. The relationship is very important, so you could build for the future, potentially what may happen down the pike, whether it's 6, 12, 18 months down the line, a working capital line of credit, if that's something that's important to you when we talk about cash flow, buying an owner-occupied building as compared to renting. So I think all those conversations would be more effective with a small business owner coming in for a loan as they're planning it out. But I think that typical joking in banking is people come to the bank when they really need it most, and that's when the financials are at a place that may not warrant what they're looking for. So
and it shows.
Plan, yeah.
Spot on. You're spot on. I would add that get a good CPA firm, let them know what your intentions are. Your CPA should also help navigate you with financials preparation. they have also communications and ties with the local banks or the local bankers. That is huge. Your CPA should know where you are and where you want to go, and having that open line of communication with him or her is tremendous. I will add that. Make sure your CPA knows where you want to go and what your plans are for year one, year two, a couple of years out, what your intentions are for your business.
I just add, Tom, that obviously transparency is king, but I think a lot of times business owners will get very focused on one particular aspect. The easy one is rate, right? Just shopping rate. And I think the point we're probably all trying to convey today is it's a longer game than that. It's not just about the interest rate for a given year or 2-year, 3-year, 5-year period. It's more so finding the people, because it's a people business that you can work with that can help support your ultimate vision, like Fabio and Vito were touching on there.
Anybody else?
I think I'm going to say the same thing Vito said, just a little bit differently. I think that understanding the capitalization of the company, I think what I've seen is that companies don't borrow enough or don't have enough capital in the company, and that creates strain, right? So it may sound odd coming from a banker, right, saying borrow more or try to qualify more, but it's that's where you see the most risk in younger companies as they're starting to grow, is being undercapitalized, not having the cash flow to sustain. So I think applying for those lines to prepare for what you've got coming up, I think is very important. The planning out, what you say, 12, 18 months, something like that, I think is very important to make sure that you understand your capital and your cash flow.
So if I heard everybody correctly, that one of the primary things is for companies to go to their bank, develop a relationship with a relationship manager, talk about what they're going to do, say that they might want to do this in the future, and make sure that they have a relationship with somebody so that when the need comes, they don't have to reinvent the wheel. They've already had that conversation about their needs. They would know, and so would the lender know what they were looking for, and that would smooth the overall process, as opposed to coming and starting from day one when the need is there, which maybe is too late for some people. Does that make sense?
Tom, I think you're right on. And then just to add one more caveat to that, having the conversation early on also allows us as the bank to help you prepare for that potential request on the line. So it's not just, okay, when you're ready, give me a call. It's really having a good conversation about what the need will be and making sure that you are heading in the right direction with the company from the bank's perspective.
So, George, to your comment about sometimes there's lack of capital in a bank, I would assume that that's where guarantees kick in. And people, I think, correct me if I'm wrong, any of you, but I would think that any small business probably should be prepared to provide personal guarantees and maybe support those guarantees with personal collateral. Does that make sense?
Definitely in the small business segment, Tom, without question. Yeah, that's so intertwined, the business and the sponsors behind the business and the operators. It's hard to separate it. You need the support from both. So definitely in the small business side, that's something people should be prepared for.
Okay.
We at JSP look for the personal guarantee on the small business side as well. There's a shortfall in collateral. We might look towards personal residence or something with some available collateral to help offset or mitigate some of that shortfall. But personal guarantee is something that we would require on our loan agreements.
Okay. And Tom, same thing here at B of A. We do require personal guarantee. Sometimes when the loans get bigger, over $10 million, there's different deal structures. But for general, we do require personal guarantee.
So all of your banks operate in several states. How important is New Jersey? And the reason I ask that is that New Jersey, unfortunately, is not ranked very highly from the standpoint of business friendliness, and we are very overregulated from a business standpoint. Is it easier for you to lend money in other states than New Jersey?
I'll kick that off if that's right, Vito. So we're the oldest bank headquartered in the state of New Jersey, and from our focus and our prime business is out of the state of New Jersey. So out of our 140 branch network, we have 5 in Pennsylvania and 2 in New York, and the rest are in New Jersey. So we're constantly looking to build out the business here in all the verticals that we talked about earlier, from SBA to ABL, commercial real estate, C&I, and all. So our strategic plans and initiatives, our tactics, our community development is really focused on New Jersey and lending to clients in New Jersey with the support of New York and Pennsylvania as we expand out. And obviously, we follow our customers. So if it takes us to a different state, for one of our customers that they're doing business in that's headquartered in New Jersey or in New York or Pennsylvania, we follow them as well. But our plan is really around what we could do to develop and organically grow in the state of New Jersey.
Okay.
And I'd add, Tom, being a national bank in Wells Fargo, that we're absolutely focused on New Jersey. Wells Fargo, through the Wachovia acquisition, has always had a nice swath of market share throughout New Jersey. We're constantly looking to add to that, and for Wells Fargo specifically, I think one of our calling cards between our branch network and the commercial bank is lending to small businesses is really one of our focuses, and something we've always done well historically.
And Tom,
we added 2 teams last year to our New Jersey bankers, business bankers. So we are growing the business banking space. To your question, Tom, I wouldn't necessarily say that getting a loan in, let's say, Idaho is easier than getting a loan in New Jersey. We like to keep our lines of business, the same through and through. It really just comes down, to the black and white, the financials, the business and how our character, our business plan, etc. But we are growing the state of New Jersey. We, again, added a couple teams last year, growing the business banking space. So we are aggressively in New Jersey. We're visible.
New Jersey is a good market, but very similar. 40 branches for us, and all but 5 of them are in New Jersey. The question around the regulatory environment, listen, it's a tough tax environment in the state of New Jersey. And it's hard, for the banks, listen, for most of us, we're nationally regulated, right? So I don't know that it's necessarily harder in New Jersey, but for the businesses, it certainly creates a level of difficulty. And we've seen over the years, people move plants to the southern part of the country or even west into Pennsylvania. So we've seen businesses react to the environment in New Jersey. Fortunately, I don't have the exact last numbers, Tom. You probably do. I think that's slowed a bit, but that's really where you see some difficulties. Not so much that it's harder to lend; it's that businesses, it's a bit of a tougher environment, and there's opportunities to take advantage of other geographies.
Yeah. So we've had a few questions pop up in our chat box, so I'm going to ask Kevin Friedlander to pose those questions to the panel. Kevin?
Yeah, thanks, Tom. So we have a woman-owned business with less than $250,000 in revenue who's also having some cash flow problems. And her question is just if your business doesn't meet the bank's threshold for revenue, like what kind of assistance can she get beyond what you can do? So I don't know who would want to answer that one. So it's a small business with cash flow issues, but not meeting the bank's requirement for a loan, $250,000 revenue.
Well, I think we talked a little bit about this before, about the connections that you have with some of the non-bank lenders, right? So can we connect that person to a CDFI or UC or the EDA or someone that we can help bridge that gap and get them over the hump? So I think there's definitely options out there, and there's agencies that we can connect to help resolve some of that.
Yeah, and I would also add to that, because that's a very good point, George, on the support beyond the banking arm. But we do loans from $5,000 to $1 million in the small business sector, so we're really focusing on those small businesses. And we're not capped at what the revenue is; it has to cash flow, right? So if it cash flows and they're in business more than 2-3 years, and they're looking for a $25,000 or $50,000 loan, we can definitely entertain this. We're not looking at just the revenue of the business.
Yeah, my history in New Jersey, by the way, is the SBDCs and all these organizations that make loans. They're very good. And again, sometimes the banks can't do it because of regulatory restrictions, but they can, and there's no penalty or no harm, and it's a very good adjunct to the traditional source of bank lending. So I agree with everything you're saying about those organizations.
And I just want to add, sometimes some of the banks have national programs, especially for minority-owned women programs, where there's grants that are given. So even if you couldn't get the loan through traditional financing, see if there's any in-house programs that you may qualify for.
Okay. Kevin?
Someone's asking if we can get the emails of all the people on this call, and I'm sure we could do that, get the contact information to everyone. Another question is, are alcohol businesses in play, such as breweries or importers? So I guess the question is, do you make loans to those type of businesses? I would imagine.
Yes,
We do,
Chase,
Kevin.
at Chase, we actually have a wholesale beverage division,
Yep.
which I'm happy to link that person with if they're interested. But we do bank, we do lend to real estate. I'm sorry, to alcohol beverage companies. It also depends on, I guess, the type of request and what they're looking to do, cash flow. But we do bank and lend to those individuals. Yes.
Yeah, Fabio, I'd echo that sentiment as well. Same idea. We've got a beverage group just the same, and work with a lot of the local brewers on up to the major brands and everything in between.
Okay. Another question is, we may have answered this, but what are the documents that applicants need to have ready to submit when applying for a loan?
I mean, obviously, I would start off by, 2 years tax returns, and depending on how complex it is, could be up to 3 years, depending on, the financials, what they look like year over year. And then if it's something specific to equipment, the information on the equipment that we'll be financing, and if it's lines of credit for working capital, what it's actually for, accounts receivables, accounts payable. So it kind of depends on what's needed, but I'd definitely start off with the couple of years of tax returns to give us a better understanding of the financials and the cash flow.
Yeah.
Anybody?
On the Chase side, we'd like to maybe see 3 years, just so we get a full 3 year historics on how the business has performed year over year. It's also helpful to have a year-to-date balance sheet and P&L, if possible, a comparison statement for same period last year, just to really see how the business is pacing this year versus last year and how you're going to end the year. Your standard AR aging, debt schedule, just so we can understand your current obligations, and an executed personal financial statement, just so we can get a snapshot of the individual or guarantors at that moment in time.
I agree.
Another question is, most businesses have a relationship with a bank, but when you're looking for a loan, is it good to stick with that bank or shop around? So anyone have any thoughts on that?
Well,
Yeah,
what I will say is, go ahead. I'm sorry.
No, go ahead. Go ahead, Fabio.
I will say is, if you're banking with someone, hopefully you have a relationship with that, let's say, relationship manager, if you will. They should be in front of you once every few months, just to get a pulse on the business. But what I will add is that if you're not happy with that bank, for example, with that individual, interview somebody else in that business. Interview a couple of banks. These are potential people that are going to be part of your team for the next foreseeable future. And if you want them to guide you through that loan process, you want to make sure it's somebody that fits your culture, that fits your vibes. You want to be able to connect with them, call them, they answer, they reply, do as they say as they do. Those are all things to keep in mind when you're shopping for a bank. And I always say it goes beyond rate. It goes to that relationship, one-on-one component. It's somebody said it earlier, George, I think it might have been you. Relationship management is key. You want to be able to connect with the borrower or the person, the individual, the banker, have that relationship with them, and know that you can count on them to help guide you through that process. But at the same time, also understand you as a person and understand your business, understand your industry. Those are all components that I think are effective when selecting a bank or a banker that meets your business needs.
Yeah, I would just build on that, Fabio and Kevin, and just say it's not the worst thing in the world. I've had relationships that I've covered for the last 15 years, and I don't think there's any harm or foul in those business owners that I've worked with for a long time, every year or two or three, sitting down with another bank and just having a conversation, just understanding what's out there. It's like getting a second opinion when you go to the doctor. I mean, if your banker is doing the right job, doing a good thing, I don't think much is going to be gained, but it's never a bad idea to have that conversation and just have a backup plan should something occur.
Yeah, I agree with that. I mean, a lot of what we talked about today was relationship management. So if the banker's doing their job and in front of their customers, they should be the first go-to person to have a conversation about a loan or a certain credit. But it's also important to definitely, if you're not comfortable with the banker you have, like Fabio said before, don't be shy to go out there and meet with other banks. I mean, there's obviously a lot of opportunities out there, but clearly, I think overall, the best deal you'll get when it comes to rate and terms would be where you're banking, where you have a relationship.
And just want to add the benefit to the client and when it comes to relationship building, especially for clients who already have done an existing loan. When you're looking for future financing, your bank already has your financials. Your bank has already reviewed a lot of the statements that we need to review. So the process is a lot easier. So it always goes back to your relationship, and your existing bank should be providing that for you.
Okay. We have one last question, and once again, may have been covered a little bit, but what typical obstacles do applicants face, and how do they overcome them when applying for a loan?
Well, I think the biggest obstacle outside of, if you're a startup, it's how well do you know the industry? A big pitfall is kind of shifting industries last minute, or if you're this, then trying to get into this industry is how well do you understand that industry or your knowledge that you bring. If it's an existing business, been operating for a couple of years, it's that piecemeal. Understand what a full package is, meet with your banker or banker meet with you, and provide that full package one shot versus tax return here, PFS, here. I think the biggest pitfall is if we can get everything consolidated or picked up or compiled one shot, it makes the navigation process through, or the loan process, that much easier navigating through. I hope that helps. Question, but packages is tremendous.
I would also add that your credit, make sure you keep your credit score high. That's a big part of what we do in small business lending. When we talk about character and beyond the cash flow of the business is how creditworthy you are. So that's real important. And sometimes people forget that that's an important factor that we look at in underwriting.
All right. And
so one thing I would kind of take away from this multifaceted conversation we had, and I kind of go back to the fact that a lot of people think banks don't want to lend money, that their job is to say no. The reverse is absolutely the truth, because if you all don't lend money, you're not going to make money. So you have to understand, for starters, that lending money is a primary responsibility of the banks, and that's what drives their earnings per share. So don't ever think that banks are not interested in your business. And in that same context, the developing of a relationship, to me, has always been the key. And I would say that for anybody who is looking to develop a relationship and you're meeting with a banker for the first time, absolutely be prepared. Know what you're talking about, know in detail everything about your company, understand your financial statements, understand what you want to do, be prepared to have that kind of discussion with your banker. And one thing I have always harped on, and it's kind of getting relaxed too much over the last bunch of years, is look professional. Dress like a professional, act like a professional, be confident. And if you do that, plus you're prepared to have a valid discussion on what your company's needs are, I think you have paved the way for establishing a relationship that's going to benefit you and also the bank. So those are some of the words of wisdom I would give people based on a lot of years of experience I've had in banking. And any of you would like to comment on what I just said?
Tom, you want to come back to banking? Listen, I think you nailed it. There's a reason we're on this call today. It's because we're engaged in this segment and we want to be out there supporting the communities that we're in. I think everybody on this call talked about expanding our teams in the last year or so, and I think everyone has plans to continue to do that. That's a doubling down on the confidence and the importance that we think of in terms of banking in the state of New Jersey in particular with this group, but it's absolutely a market that we're in, and we are absolutely open for business. And I think that's universally shared across most banks.
Yep. I think my comment overall would be that as a banker, and you all are in the same category, nothing makes you feel better than lending money to a company and watching that company succeed. I mean, it's it's those are the memories that you like. That's what you want to do. And I think if you follow some of the advice given by these five gentlemen today, you can develop that relationship and succeed, and everybody's going to come out a winner. So I really want to thank George, Andy, Vito, George, and Fabio for participating today. I hope what they've passed on to you in the audience will be helpful. I want to thank NJM Insurance for being our sponsor for these many years. We thank you for that relationship. And I also want to talk about a couple of events that we have coming up that maybe I think would be very beneficial to all of you in the whole relationship and networking realm. On the 14th of November, we have an event with the African American Chamber at the Pines Manor in Edison, our third annual DE&I Trailblazer Awards, very well attended event, a good opportunity to get to meet people from a networking standpoint. On December the 4th at the Hanover Manor, where we're supporting ROI&J in the second annual C-Suite Awards, which probably was one of the most well-attended awards ceremonies we've had in the state in many, many years. I think if you look on our website, you'll see how popular that was, and I would highly recommend you attend. We also have for our members, December the 10th, our holiday party at Calandras in Caldwell, and Calandras is an institution that is in a league of its own, so please plan to participate there. And most importantly, next year on the 6th and 7th of February, we're bringing back our Walk to Washington train trip, which is the largest networking event in the country, we are told. It's going to be a huge event this year, probably 1,000 people plus. We would highly recommend that you look at our website and participate in that. All these events will bring together companies, bankers, lawyers, accountants, and be very beneficial from a networking standpoint. So again, thank you to the five professional bankers on the panel today. Thank you for the participants, and thank you to NGM Insurance. And I hope everybody has a great day. Thank you.
Thanks, Tom. Thanks, everybody.
Be here.